Now that the election is behind us, the fiscal cliff is front and center. So where does that leave the market, and how should you be positioning your portfolio? Here to weigh in are Todd Schoenberger, Managing Principal for the BlackBay Group, Lee Munson, Founder and Chief Investment Officer of Portfolio LLC, and Brian Sozzi, Chief Equity Strategist for NBG Productions and Editor of the Decoding Wall Street Newsletter. Gentlemen, it's great to see all of you.
Likewise.
I want to start off with the fiscal cliff. Lee, the election has come and gone, and we're still staring at the same partisan, gridlocked Washington. Same president, same composition of Congress. How does this bode for resolution of the fiscal cliff before year end?
They're going to have to work it out, and the best thing for investors is that they're the same people that are going to have to work it out. So I don't think that we're going to do anything in the next 2 months. I think that if I were one of the politicians, I would probably do a lot of saber rattling and say, I'm not going to work with anybody. But starting in January, once we have to start extending out so we don't actually have a fiscal cliff, that's when the rubber's going to meet the road.
So you think we go over the cliff, Lee? Is that what I'm hearing from you?
Well, what's going to happen is that there's a mechanism in there where they can delay that actual cut in funding for little bits of time as we get into January. So it's not a hard stop on January 1st, as many will, may think. But I think it's going to take about 6 months to really work out a compromise. Everybody wants to do it. It's just about getting the public more confident. But no, I don't think there's going to be a fiscal cliff. I mean, you're insane if you think that.
All right, Todd, let's say that a deal does get done. Depending on what this looks like, let's say there's the expiration of the payroll tax cut, which is expected. Yep. Perhaps unemployment benefits that were extended also expire. Do we still see some drag on the economy, even if there is a deal?
No question, absolutely, and it's horrific. Look, even if there is a deal, you have to wonder, what is the negotiating going to be like? Because we're talking about, not to mention that 2% payroll tax, you're talking about for the extended benefits, you're looking at Americans. You have 5 million right now, Jennifer, that have been unemployed for more than 27 weeks. They will be left out. They won't receive another nickel. Then you have another 55 billion, 9% of the defense budget that's going to get hit. The GOP doesn't want to give that up, and with everything that's going on right now with the geopolitical unrest, clearly it's not going to be something that's in favor for Americans. Look, going forward, it will have a drag on the economy. If it wasn't for Ben Bernanke and the Fed, we'd be in a deep recession as it is right now.
Shifting away from the fiscal cliff, Brian, I want to talk about commentary from companies' third quarter earnings and how that bodes for the economy. A lot of companies across industries lowered their sales and profit outlooks as the global economy has slowed, and given uncertainty about the global economy, Europe, China, and of course domestically the fiscal cliff. Yet if you look at the consumer, spending has picked up as of the third quarter and confidence is at a 4-year high. Who's right?
Well, I think Mr. Market is right, and I will take a page right out of Rocky 3, and I'm predicting more pain, as Clubber Lang would say, more pain within the fourth quarter earnings season. Going back to third quarter, we saw nothing of encouragement. We saw sales warnings as earnings warnings, but specifically within Europe, and we certainly had Draghi dropping more bombs, spreading of contagion, companies not having pricing power. And if you look what happened post-election, think about it this way. If you're out there voicing that your business is subdued or suppressed, did anything that happened over the past couple of days solve any of that? I would say more uncertainty has been created. Great example, look at what McDonald's has come out with its latest sales report. It's telling you it has to price its products more competitively despite it being a value player. So right now, it's hard for me to get encouraged about fourth quarter earnings season. And then ultimately, if I'm worried about fourth quarter, I'm worried about the front half of 2013. And if analyst estimates have come down far enough, I don't think so. I don't think we've hit that margin bottom where you can invest into and hope that you do get some upside surprises. I'm not too enthusiastic right now.
I disagree with Brian a little bit on this. Listen, I agree that every CEO in this country right now is terrified of Europe. And they're using the fiscal cliff because they don't really want to say, hey, everything is about a recession in Europe. We're going to have margin problems when we have to start hiring people. But I would take a bit more optimistic viewpoint. I do think that Brian makes a great point of, are we guiding down enough? I have a little bit more faith on the market as a whole that CEOs are guiding down enough. I do think we're going to see some global growth in 2013. But, I'll concede some of Brian's points is that those margins, we never hit peak margins, but we got close to it. They are going to compress. So I think the real game of guys like Brian and me, where we're going to start clashing, is going to be, can we move that top line revenue high enough to make up for crappy earnings per share.
Absolutely. I definitely agree with you, Lee. Now, Todd, what is your take on earnings? Do you think that earnings bottomed in the third quarter, or do you think there's still more pain to come, like Brian?
Well, you would suspect that we would have more pain. However, if you look at history from the past 2 rounds of QE, you would assume that there was a manufactured wealth effect. So you had Americans going out, they were spending more money. There was a bit of demand there, so therefore that did help with earnings. However, with that said, you have a global slowdown. The McDonald's news is a proxy of a global slowdown. 40% of its revenues come from Europe alone. Europe's slowing down. China's slowing down. If McDonald's is going down, and I give, Brian brings up a brilliant point about, being more competitive with their pricing. However, I think their margins, they're already wide enough as it is. You could get competitive all you want, but I don't think that's going to really structure or help them. And therefore, if you have a McDonald's that's vulnerable, what are the other companies like that? So going forward, look, you have a 3% quarter-over-quarter earnings growth rate right now with the current earnings season. Going into 2013 now, too many uncertainties, too many headwinds. We're probably going to have quite a negative impact for earnings in 2013 that will negatively impact stocks.
Does that mean you think we're going lower then for the market?
Definitely. Are you kidding me? Look, you have a current environment right now with an administration that was just reelected. It's just handouts, or it's like Santa Claus. They're giving out everything right now. So going forward in 2013, you have to wonder, where's the growth going to come from?
Lee, what about the Fed? Because the Fed has really been the white knight, at least up until recently. Do you think, we know that Operation Twist, the second installment, is going to expire at the end of the year. Do you think they come back in with a new sort of stimulus program in addition to QE Infinity?
Well, I don't know. And I think a lot of it, where I think that I would disagree with Todd, and I think this relates to, are they going to do more twists, is that I think that we're going to have to come in with more CapEx spending. And that's what the problem is. If we don't get CapEx spending, which is going to lead to more hiring, which is going to lead to compression of margins, then I think stuff like what Todd and Brian are, that's going to happen. We're going to have a crappy 2013. But I disagree with that. I think that, when people are giving handouts, I love it. When Santa Claus and the bearded wizard start finding out every risk-free asset and investment banks start having to figure out how are we going to use corporate bonds to have collateral for derivatives, I like it. Now, we cannot like that because we know it's not a good thing long term. But hey, listen, if somebody's going to give me a tax refund for nothing or give me a handout in the market for nothing, I don't care. I'm going to bid it up. So I would say that I don't think renewing a twist is necessary for Bernanke to get things going next year. All I think is they need to do one thing. They print $40 billion a month. They buy up everything that's totally safe. And then all we need is for CEOs to start doing a little bit more CapEx spending because they got to get back to work. They got to do something to convince analysts they're going to increase the ROI and they're going to increase their top line revenue. And I think just the width of CapEx spending, I think that's going to bring expectations higher. I think we go higher in 2013, and I can't wait to rumble with Todd about that next year.
All right. Well, let's go around the horn and find out where you all are finding opportunities right now. Brian, how are you positioning your portfolio now?
I'm looking for companies doing more business with less infrastructure and also have a housing tie-in. One name that we continue to like is Whirlpool. Over the past couple of years, this company has basically shut down many manufacturing facilities. Their sales mix is very favorable. Pricing power, believe it or not, within Europe and the US, that kind of excites me, gets me a little warm and fuzzy. Another one would be Mohawk. Now, Mohawk, the carpet maker, housing tie-in, they're selling some of their best products right now are the highest margin, and they just went out and bought Pergo. I'm a Home Depot fan. I kind of got excited by them buying Pergo. I think that'll give them more leverage, more stuff out the door. And the fact of the matter is this, the housing market is, I look at it as a ship that once you start moving, it's going to be hard to turn it around going into next year, even despite all the ridiculousness that's happening out there.
All right, Todd, you're shaking your head. Where are you finding investment opportunities? How are you positioning your portfolio for an Obama win?
The housing sector. Come on. You might as well just burn your money. Why you would have more money, more equity in a Ford Focus than a house right now. Let's be honest here. But look, here, where am I positioning it? Look for things that are going to mimic the U.S. economy. An Obama administration, it's the same, like you said at the top, the makeup is still the same on Capitol Hill. So as a result of that, going forward, 2013 is going to be a dire time. Look for the dollar stores. Look for a public storage. People are going to continue to lose their homes or they're downsizing. Therefore, they're going to put they won't get rid of the family dining room set. They want to put in one of these climate-controlled facilities. Public storage is a wonderful REIT because it's an almost all-cash business. Dollar stores are great. Consider that. And, of course, Apple, because Apple's always just going to be.
All right, let's come back to Apple in a minute. Lee, quickly, where are you finding opportunities now?
Oh, well, quickly, I'm lazy. I'm not even going to buy any individual stocks. I'm looking at REITs. I still love the REIT market. Why? Because we have an administration that's going to screw up, things with the tax preference. Right. REITs don't have a tax preference, so you can't take away what you don't have in the first place. So I still think that commercial real estate's the place to go. If we get any capex spending, people are going to feel more comfortable with it. The valuations are still reasonable. I still like, right now, I think if you want to make a play for something that's kind of cheap right now, I still like the emerging markets. They've got problems. Their central banks aren't very sophisticated. They don't know what they're doing. We've got problems in China. But I really think that at this point we've kind of bottomed out in some of those frontier and the emerging markets. I think that they should outperform the U.S. markets in general. And I think if you want to make a play on America, I say look at smaller companies in general.
Todd, one of the most pressing questions for investors concerning the fiscal cliff is whether or not there will be a tax hike on dividends. As a result, we're seeing companies issue these one-time Mondo dividends before year end. Care to wager which companies might be issuing big dividend payouts before year end?
It rhymes with Scrapple. It's going to be Apple. I'm telling you, this is a company. You're $120 billion in cash right now. If you have one company out there, it's going to be that company. I also look at some of the financials. Look, JP Morgan's one of those, Morgan Stanley, maybe even Goldman Sachs. Because remember, bonuses are going to be cut in the financial services sector, but you have employees that own that stock. So in a quasi-bonus of sorts, this might be an opportunity for some of those companies.
All right, let's talk about Apple. I mean, what do you do here? The stock's down some 20% from its all-time high back in September. You've got the new iPad mini that was launched. Then there was the management shakeup that saw the departure of the company's heads of mobile, software, and retail operations. What do you do if you own the stock? What do you do if you don't own the stock? Todd, then Lee, Brian.
Apple, buy it and buy some more and buy no leverage, because I'm telling you why. This is a company, they're going to net $48 billion in cash by the end of next year just on the iPhone 5. The mini iPad is something that's breaking into a new market. The thing that concerns me, though, is that they haven't created any new products, any new ideas. They are a category killer, but they don't want to have to chase. They want to create new categories. Hopefully, Tim Cook will be able to do that going forward. But the iPhone 5 is a reason enough just to buy this stock.
Lee, what's your take on Apple now?
I'm going to ask Siri on my new iPhone 5 what I should do.
You're so fancy.
Got this thing. I don't even need this thing, but I love to buy. I'm talking to you on an Apple. I've got Apple stuff. My whole business runs on Apple. I'm not quite as aggressive as Todd on that. One of my portfolio managers here at the firm was whining about Apple. What do we do? Because it's one of our larger individual stock positions. And I said, listen, you have two choices. Do nothing, or you do nothing. And if you need to hit the panic button, you can sell a little bit of it now and either buy it at 600 or buy it at 520, where I think it has support. But I don't think, if you own Apple right now, I don't think that you need to do anything. And if you're looking to dip your toe in, flip a coin, buy it right now. If I saw it at 500, 520, where I think it has some technical support, I think it'd be a screaming buy. But by the time it gets to that level, where the Apple addicts say, I've just got to start selling. When you start seeing on Twitter people throwing in the towel on Apple, then I would do the Todd thing of, sell the house, sell the kid, sell the dog, and buy Apple. So,
all right, Brian, what's your take on Apple?
Well, if you don't own it, I think right now you have to just sit tight, as in you don't go for it, because what Apple is telling me, it is a sentiment-driven play. And when this thing starts going against people, we've learned that it's going to start going against them. It's going to feed on itself the negativity. The valuation on this thing, we all know that 9, 10 times earnings, whatever it is, it's not working. Buy and hold, Ben Graham stuff, not working. Right now, wait till the selling subside. Then you can start thinking about 2013. The company has to show me a little bit more they have to put up a good quarter right now. Believe it or not, and I can't believe I'm saying this, Apple is a show me company. I want to see a very, very, very good holiday quarter. And then you can look to 2013 when they start to bring costs down. They're stuck in the pipeline with a lot of these products globally. Then maybe I can get a little excited about it. But it starts with this holiday quarter and the weeks going up to it.
All right, gentlemen, thanks so much for that lively discussion. I so appreciate it, and I hope to see all of you soon.
Thank you.
Thank you.